Hi everyone. The market is sending critical signals before Wednesday's events. The stock market is at all-time highs, but insiders are selling at the fastest rate since 2000. And why did the Federal Reserve just hold an emergency weekend meeting with Wall Street banks? This information is too time sensitive to wait for a full video production. So to get you this analysis as fast as possible, I'm sharing my screen and walking you through my blog post. I've just published it and the link is in the description. So let's get started. As you can see, the stock valuation have never been higher, even at the peak of 1929 and the dot-com bubble. We are at a different kind of level of insanity. Another thing that's kind of interesting is that the US households now have 52% of their financial assets in stocks. And that's a level that's much higher than at the top of the dot-com bubble again. So really shows you how they are all in, and anything other than with the continuation of the bull market could wipe out a lot of people. At the same time, also, something we haven't seen since the dot-com bubble is insider selling like this, as you can see on this chart. It's really increasing. So the people who know what's really going on versus what the headlines have been, they have been selling massively for months now, but it seems to be accelerating. This is just another chart to show you that in the past, it was a stock market crash and then a recession. This times, it seems to be the opposite. We had mostly the recession data that has been kind of growing since 2022, yet the stock market has been on the rip. But if you watch other videos, you know that it's likely because of the AI narrative that kind of broke the market in two. So the real economy went down and the stock market went up. And this is a mega divergence. And I have another chart to show you also, this week is going to be critical. So that's kind of why I wanted to do this video quickly, because on Wednesday, we'll have the FOMC minutes, which will tell us why the conference last time was a bit hawkish, with Powell saying that the December cuts was not a done deal, basically. So we'll know more about this and about the divergence and what's likely going to happen. There's going to be the post-shutdown data dump that should start on Wednesday or Thursday, depending on when we get the data. And then at the end of the day, on Wednesday, we have Nvidia's earnings, which is, probably the one thing that could really completely crash the market if they don't beat earnings. I mean, in theory, they should beat it because everybody has been beating them because they really lowered the target, so it's kind of easy. But if they don't have amazing earnings, amazing guidance, the market right now is priced for perfection. So that could be really a big catalyst for, even a 5% down market the next day or over the next following day. So definitely, it's going to be a busy week. And then I mentioned in previous video, we have the option expiration for the month. And a lot of people are betting on Nvidia and other things. So there will be a lot of volatility. So regarding the AI bubble, I found this interesting chart to show you how, when you look at the stocks that were pushing the 1929 bubble, the chart looks kind of similar. And it's funny because it's looking at in terms of months. And so even though it's not exactly the same shape, you see that a similar type of bubble kind of peaked exactly around the same time as right now for the AI bubble. So something that is worth considering. Something else that I haven't mentioned yet, but I initially talked about Michael Burry when he came back after 2.5 years of silence. And since then, he gave us more information. The main tweet was this one, which I put here, which is about saying exactly why he's shorting companies in the AI space. And one of the reasons is because he thinks they are really overstating their earnings because they are doing accounting gimmicks by using a longer depreciation or amortization of GPUs versus what they should be doing. So for example, 4, 5, or 6 years instead of 2 to 3 years, which seems to be what the experts said those GPUs are good for in terms of the value, because if a new GPU comes out and delivers twice the value, of course you can still continue to use the old one, but it's not going to have the same value. And so those amortizations should reflect the reality, not the narrative. The other thing that's about Burry is that it chose to close his fund. So that was kind of a surprise for many people. And after thinking about it, I think the main reason why he wanted to do this is because he didn't want to deal with people who might want to withdraw the money at the wrong time and panic, just like he had to deal with during the 2 years that led to the 2008 crash, because he saw the early signs in 2006. And so this time he was probably like, I'm going to focus on what I need to do, and I don't want to deal with people, just being in the way type of things. Let me know what you think, but that's kind of my take on why he's closing his fund. Also, maybe he's more free to talk about what he's really seeing versus if he had still to manage other people's money. Something also interesting with the AI narrative, it seems like every time there's a bad news in AI, that usually comes out because, we discover the cracks. It's like someone goes on the TV or gets an article out to say how AI, there's unlimited demand. And this is just an example of AMD, after, I don't remember exactly what it was, but there was a bad news about AI the day before or that day. And then this article comes out. So, it's kind of weird how there's always a new deal announced every time there is something bad to kind of try to keep the narrative alive. But yet, what I found really interesting is that the same CEO of AMD called the AI spending a gamble. I mean, even if she says it's the right gamble, why would she use a word like this if the AI narrative is supposed to be a sure thing? Also, this chart of the Oracle cash flow being deeply negative, I think is something that is going to be more and more something that comes out of AI companies, because before 2025, they were using mostly free cash flows to finance all the AI stuff. But since 2025, they've been all in on debt. And so that's why right now it's kind of eating a wall, because it's a different story when you're using other people's money to do something that's a gamble, not a sure thing. And so, as you can see on the next chart, Oracle has been nosediving since the all-time high by more than 30%. It's only been like a month or two, maybe. And so this tweet was talking about maybe this will be what Nvidia looks like after the earnings. So we'll see, but right now it's not looking good. Another domino that was falling was CoreWeave. There was a lot of hype before the earnings, and the earnings guidance wasn't a lot of insiders at CoreWeave that sold before those earnings, so they knew already that it was going to be bad, even though they beat the earnings technically, but the guidance was really bad. What Nvidia is going to say to try to prop up that market, but I think it's going to be really tough because, like I mentioned before, that market is priced for perfection. Something else that's kind of broader about the stock market, but I think most people don't understand how bad it is. Right now is supposed to be the best time of the year for the stock market in terms of seasonality, because it's like for so many reasons. But I want to make a short video, so I won't get into all the details. Right now, the element I wanted to bring to your attention is that after the blackout window during the earnings where they cannot buy back their own shares, which is something they've been doing a lot in the past few years, now 94% of the companies have the right to buy their own stocks. And they really do it in a way where they are price insensitive. So usually when the buyback blackout is closed, they can really go for it and just buy a ton of it. And that's one of the reasons why the stock market usually goes up after the earnings. So when you look at the stock market, especially today, closing for the first time for the SP 500 below the 50-day moving average, which, first time since April. So I think that was the longest time ever for the market in terms of number of days above the 50-day moving average without closing below. So this is really kind of interesting that just 2 days before Nvidia, the market is already kind of tanking, and we saw some panic as well. My indicators were triggered this morning. So just to tell you that this should be the best time for stocks. This should be the massive buying of big companies. They don't care about anything about the price. They just buy. And despite all this, the stock market is going down and potentially crashing. Something else here that I wanted to show you, which I found interesting, when I was talking about the real economy has been in recession since 2022. Well, here I saw an interesting tweet of someone who basically put a basket of real economy companies, not AI or tech, and basically it's been down by 39% over the last 3 years. Also, something worth looking at is when you price something in gold, you get a real measure of the value. Here, you can see on this chart that the red line is the stock market, the S&P in gold, and it's been flat to down versus the nominal in blue, which looks great, but if you're losing purchasing power, what's the point of the thing going up? And just briefly, the Hindenburg omen has been triggered again for the 8th time. So we're really talking about, so many indicators that just tell us the risk reward is not with investing in the stock market right now. And there are a lot of charts. This is just one of the example of what looks like a massive crash about to be triggered. And I also mentioned in my last video that this is kind of my base case for a big drop, then a bounce, and then potentially a big drop or a melt up if the money printing restarts like in 2020, 2021. This is the mega divergence I was talking about before, where you can really see Wall Street versus Main Street. And this is the first time in history, as far as I know, that it's been so wide. So that's why, it just, every day that it gets wider, it means that the one day when reality is going to come back, it's going to snap probably very violently. If you think the crash of the earlier this year was fast, I think the next one is going to be even faster. I think the breakers will be triggered because it will just drop too fast. So they will probably have to close it for a few minutes, and then for the day, if it keeps dropping, like I think it will. In terms of the real economy, there are other things that I wanted to share quickly. People are looking for a second job at all-time highs. Think about it like in terms of 2001, 2008, 2020. Like people have never been that bad in terms of looking for a second job, and yet we keep hearing that the economy is great and there is no need to support the economy. Another thing that kind of supports this is the 401k hardship withdrawals. So that's people who have retirement accounts in the US and they just need to withdraw from it because that's the only way that they can pay for bills and other things. And so that really shows you how the economy is getting weaker and weaker. University of Michigan Consumer Survey, and shows you how it basically right now it's the worst employment expectations in the last 45 years. So that's also insane when you think about the past times where people were really depressed, and yet this is worse than all the other times before. Also, the ADP report, which was the only data about jobs during the shutdown, also posted negative reading for most of October. And so once we get the data, if we ever get it, it's likely going to show a big drop in employment, not in terms of growth, but actually being negative. And so that's going to be probably a big turning point. This chart is the actual goods being shipped across North America. And so it's all the trucks and all that. And right now it's lower than at the worst time of 2009 or during the 2020 recession. So think about the whole economy is closed, and yet there were more trucks on the road than right now. So that's insane when you think about it. Also, small business have been doing really bad. So they've been reporting lower sales for 41 consecutive months. That's also insane. Other countries have issues as well. Like the UK today, they posted the first month-over-month negative GDP. And Canada, mortgage default have hit a 5-year high. So even though it's not a high number in terms of history, it's been on an uptrend for the past 3 years nonstop. So hence the longest time it's been on an uptrend like this. So it's more about where it's going and the fact that it's likely going to get worse rather than just the fact that it's not super high in terms of the nominal number. Let's talk about the Fed emergency meeting. So they had to meet with the banks and the brokers on the weekend because there were many issues in the system. But the main thing that I noticed is that it wasn't just because it was a minor plumbing issue. It was a solvency crisis. And this is when you have bad debt, not just a liquidity crisis, which is not having cash. And I think the most telling part of it is that there are some banks that would rather sit on cash than lend it to other banks at any rate. And this is the kind of breakdown of trust in the system we saw in 2007, because the whole thing froze when people discovered that the collateral they had was not as good as they thought. And so then from one day to the other after Lehman Brothers, nobody was trusting anyone. And that's kind of what started the whole financial crisis. Another example of this that we saw recently was UBS. They had to close funds that were supposed to be high grade, and so that's supposed to be like very safe. One of them was bankrupt. The other one was because people were just freaking out and just trying to withdraw everything. And so they just closed the two funds. And this is kind of similar in a way to what happened to Bear Stearns in 2007. So that was kind of the canary in the coal mine. After Bear Stearns, the central banks and the government came back and say, everything is fine, no need to worry about, everything's under control. And of course, every time they say this, a few months later, it's completely the opposite. So this is just something that, it keeps developing, that banking crisis. And I think we haven't seen the end of it. Another thing that I found interesting was that before 2008, the Fed was saying that they were the lender of last resort. But recently, they said that they are the lender of only resort, and that's a big difference. And Powell said it in 2021 that in a stress scenario today, the Federal Reserve is the only entity with the balance sheet to absorb the shock. So this is really different from past scenarios with a bubble, because this is the first time in history that we'll have a bubble bursting with the head managing. And because they're always late to react, I'm not very confident in how this will happen. Also, if you remember back in 2020, when the crash happened after the announcement of the pandemic, the Fed reacted right away, but the market kept crashing because the market didn't trust that the Fed was going to save the economy. It took massive money printing from governments, not with the help of central bank, but it was really the fiscal decision that made the investors say, okay, fine, we'll stop the bleeding and we can reinvest again. And so this time, well, we'll see what happens, but I'm really not confident in the Fed when the bubble burst, especially because they were asked about the AI bubble in the last press conference, and they said, what bubble? There's no bubble. It's different this time. I mean, come on. When the Fed said it's different this time and the market tanked the next day, it was probably the top. Like, that shows you how out of touch they are. And now let's talk about Bitcoin. So as I mentioned in a previous video, I was watching very closely the 95K support level. And unfortunately, it broke down, but if you know a technical analysis, it doesn't mean that the bull market is over. It just means it needs to be confirmed. And so that's why here on the chart, I put the white line at the lowest point of the weekly candle from last week that closed. And so right now it's lower, at least when I took this screenshot. But if we close the week higher than 92,929, in theory, the breakdown will not have been confirmed, and this will just be like a fake out before it resumes the uptrend, or at least it's consolidating. So we'll see how it goes. It could still go lower. You can have a long candle for a long wick for the candle. Basically, I'm looking at two potential other level of resistance or support, depending on how you see it. So it could go down to 90 because it's a round number. It could go down and then bounce. I think the more important number is the K, because that's the active investor realized price from Glassnode, which is a website that gives a lot of data about crypto and on-chain analysis. And this is the average cost for all active coins. This is something that has been a critical support in past cycles, because this is more for people who are active on the chain. There's something interesting that I've found that kind of supports the fact that it's potentially a local bottom in this area, because we're seeing capitulation from short-term holders, which is something that you typically see at the bottom. So this chart is kind of showing you this in the September 2024, just before the big run. We had some similar data, so this is interesting. Also, something that's kind of different this time. So I'm not saying it's different. I'm saying it's kind of different. Is because the main dynamic has changed. So in previous cycle, it was just retail. And now we're seeing a big transfer from long-term holders, which are mostly retail, to institutional investors. And they have been basically taking most of the Bitcoins that have been sold by long-term holders and short-term holders. And so that's why the price is kind of holding up despite the extreme fear we see in the market. Yeah, this chart, basically, you can see the red. This is the selling of long-term holder. And usually when you see this, like, the market should be crashing, 50%, or at least in the past, that's what happened. This time, it's only been crashing by 25%, which even smaller than the pullback we've seen during this bull market. Something else too is that recently, so between October 24th and November 7th, whales have been accumulating Bitcoin. So also something that's kind of bullish for Bitcoin is that stable coins are being moved to exchanges. So this is like dry powder being ready to be deployed, often a sign before a big price increase. Many septecs of the past few years are finally folding. You can think of all the people who call the Bitcoin a rat poison, or the worst thing, or a Ponzi, or whatever. Even the Deutsche Bank in Europe told other central banks they should be buying Bitcoin. And so the Czech National Bank actually did that today. Well, I heard the news today. So they might be the first central bank to buy Bitcoin. The fear and greed index, this is really interesting, because with that level of fear, usually you would expect Bitcoin to have crashed by like 50% or more. The fear and greed even went down to 9. I don't have the screenshot, unfortunately, but went as low as 9, which is lower than during the FTX crisis, which has the lowest of the low in terms of what I remember for the the sentiment of people. So it's interesting to see this. And also I put the chart with all the data I can. And as you can see, really, it's not something you see often to have an extreme value of 10 or below. So usually it's really at the lowest of a bear market. The Google trend also seems to be pointing to the same thing. The current level of people looking for crypto or Bitcoin is at the lowest, at the levels we typically see at a very low or a bear market low. When McDonald's bring back the Maghreb, usually it's a good time to buy Bitcoin. So as you can see on this chart, it seems like every time they brought it back was during some kind of weakness before big pushback. So, it doesn't mean anything, but it's just kind of a fun indicator to add to this analysis. So, to sum it up, it's not done yet, and there are a lot of good and bad indicators for Bitcoin. But right now, the bull market is not technically broken. So we'll have to wait for the make and break decision this weekend. So when the weekly candle closes on Sunday, the price has to be above that 92,929 to resume the bull market. And if it doesn't, I think it's going to really start the bear market, which, as I mentioned before, will likely go down to between 75 and 80K at the lowest, because there are a lot of people who've been on the sideline for years who are waiting for a good price to buy Bitcoin. And so I think if they have the opportunity to buy it, around 80K, they would jump on it. So that's it for the blog. If you want to subscribe to receive it by email as soon as I publish it, feel free to do it here. I hope this was helpful. And if you have any questions or comments, please let me know. And also let me know about the format and the delivery of this content, because I wanted to give you this information as soon as possible, but if you prefer to wait a day or two for more polished video, please let me know. So thank you, and until next time.